Turkey's Erdogan announces incentives to boost births. Venture Global sets IPO at 50M Class A shares.
This is the Daily Market Rundown live from the Tradelo Trading floor. It's January the 13th. Some highlights. US yields are set to test 5% on the 10-year. Risk off is the only game in town. And BTC is set to test 78,000 in the short term. Good day, traders. Quite a lot of things happening out there. Let's briefly talk about Friday. We obviously had quite a blowout jobs report with the headline number coming in almost 100,000 above the mid expectations. We also, of course, had unemployment rate ticking down. And what that's meant ultimately for the rates markets is that there's now calls for effectively a Fed error in that, the Fed perhaps has cut too much or should never have begun the cutting process in the first place. What that's leading to ultimately is a number of things, and I think it brings us to the first sort of topic line today, which is, ultimately, if we look at the implications of what 5% yields mean, it can be nicely summarized in this article. And I think there's a couple of key takeaways from it. Ultimately, it's not just the fact that absolute yields are at 5%, it's the rate of change. Okay, if you look at the 10-year, which we will do in a moment, we're actually up over 100 basis points in just a case of 2 months. Okay, and it's normally that rate of change that always creates some degree of risk off for the market. So we obviously showed you that chart on Friday, the steepener. We can see the curve is very aggressively steepening as well. And all this leans on this idea of, can corporations adjust to this rapid change in rates? And I think that's what this article is leaning on. It's this idea of, as that yield ticks up, as we move towards that 5% and perhaps higher, what is the solvency issues that come as a result? What does it do to the deficit calculations for the US government? What does it do for any new debt being issued by the US government? So there's a lot of uncertainty that comes with this yield rise, and that's why we are now seeing quite a little bit of paring back in the risk scenario that we saw late last year. Keep in mind that it was very much a near certainty with Trump coming into power that this year was going to be a stellar blowout year for risk markets. Why? Well, one, we of course had Trump coming in and deregulation and a lot of government spending, and at the same time there was an expectation the Fed was going to continue to cut rates. Okay, don't forget, it was 3 weeks ago the Fed told us they still think 2 rate cuts are coming in this year. The result is right now the market thinks there's no more rate cuts, and in actual fact there's quite a number of institutions talking about rate hikes coming into view later on this year. Now, should that be the case, what you will see is you'll see almost all institutions flip their forecasts. Okay, keep in mind the whole of Wall Street was expecting an average of 10% upside in US equities this year. Should we see rate hikes back on the table, that of course flips completely, and we will start to see a lot more calls for perhaps some sort of a down year in equity markets. So that's very, very important to pay very close attention to. Now, looking at that yield chart, that's what we're staring at. We're staring at the scenario where 2-year yields have not really moved this year. It's been all driven by the back end. The reality, though, is we can see that as of today, we've now gapped up above that range in the 2-year, above that 440 level, and 2-year yields look like they're now going to lead the way. In other words, it's very much been the back end that's been driving these yields higher, but now the 2-year is set to join the party. And what that means is we're just likely to see that 10-year continue its progress up towards that 5% mark. Now, What does that mean for markets? Well, it's not good. It's not positive. There's a lot of uncertainty out there, and uncertainty just means one thing for us as traders. Don't try and go up against it. Don't try and go up against the flows. If we take a look at the S&P 500 chart, you can see that since November 2023, we're up 50% in the S&P 500. Okay, so what you're seeing now is the beginning of ultimately a correction for the US equities. How deep does it go? Well, we don't know. I think the key takeaway is you don't want to be standing up against it. You don't want to be picking levels. You just want to either go with the flow or stay out of it. Okay. Now, that being said, what sort of size corrections do we have? I think there's a couple of things we can lean on. I think this feels and looks a lot like the correction we had in July last year. Keep in mind that's when Google came out and said, look, we're concerned that all this investment in AI is not going to deliver returns anytime soon. The result was we had a 10.5% correction. Okay. Now, I think if you are going to go and take that same sort of view of, a 10.5% correction, given the entire market is long, given the positioning is very skewed towards more upside, that puts us somewhere around the level of 5,500, which is over there on the chart. And you can see that coincides with the September lows. Okay. So if you're going to do a bit of baseline technical analysis, maybe you're going to go look at some of the depth of these pullbacks. I would say a 10% correction comes in around that 5,500. Will it stop there? I don't know. Okay, the point is I think that's a pretty decent target. In terms of support, there isn't any. There's now just sort of a one final zone in the S&P 500, and that comes in at 5,800, which is just slightly above the overnight lows in the S&P 500 today. Okay. Now, one thing to pay very close attention to, in the purple here, you can see the VIX, and you can see that VIX very much is still actually quite low. Okay, and that's very, very important because we're getting a little bit of divergence here where you can see at the late December, we kind of got the spike in the VIX up to 21s. And at the same time, that's when we had the flush out. Now, we haven't quite had that same flush out. We have kind of had the series of lower highs in the VIX. Keep a very close eye on the VIX. I think we close above 20 today. It very much confirms that we are going to break below that 5,800 and move towards that 5,500 mark. So I think VIX will be a very, very important clue today. Should we get past today unscathed? Okay, should the VIX close at 18s today and we sort of hold on to this 5,800 level? Sure, we're still very much in a bull market and yields could back off. This could effectively be the high for yields for some time. So we do have to keep a very open mind. Okay, but sentiment ultimately is negative. Right now, you just got to pay attention to those yields. They do seem as though they're going to move towards that 5%. It does feel like we do need to have a little bit of a risk-off type liquidity event for ultimately bigger investors to step in and start buying up bonds as well as buy the equities again. Okay. Now, one final note or two final notes. Don't forget the Russell. The Russell is massively underperforming over the course of the last quarter. We can see the Russell is currently 11% down from that record high. It, of course, was also a double top on the technicals. And the Russell is an interesting one because we are now getting into this area where we've broken below 2,200. We closed below it. And these rates, this higher rate environment is always going to be far more impactful on the Russell. So keep a very, very close eye on that. I think Russell's got a very good 10% easier move back down to that 2,200 mark. I suspect that's where we're going in a relatively straight line over the next couple of sessions. So keep an eye on it. I think technically below 2,200 does spell trouble in particular for the Russell. And then finally, we had one more chart. I don't know where it is. We had the Bitcoin chart up. Keep a close eye on that. I will annotate that for you. 91,000 is the key. I think the market is very much now on slippery ice. This 91,000 has provided support for a number of days. But if that goes again, you're probably going to see some degree of a liquidity event. Not many people want to be buying it at 89,000, 88,000. I think if you're going to look at levels in terms of Bitcoin, I think 78,000 is a very good near-term target. I think we trade there some point this week. And below that, of course, we've got the Trump breakout around that 68,000 mark. So somewhere between 62 to 68,000. That is a full retracement, of course, of the election play. And I wouldn't be surprised to see us get back down there in a relatively short space of time. Okay, that's it then for today. Very, very important. Just a word on risk. Market risk is elevated now. Like I said, it's not a time to be clever. It's not a time to be trying to take on some contrarian trades just because you think we're in a massive bull market. The reality is that the market's nervous. Yields are pushing higher, and if those yields continue higher, you are going to see that nervousness just compound on itself. Okay, so VIX above 20, all bets are off. Don't be afraid to be a little bit more aggressive in the markets. But as always, when there's volatility, manage that risk. Okay, you're going to need to use slightly bigger, sort of stops in the markets. And don't forget, volatility is always a two-way street. Okay, what do I mean by that? Well, we could very easily see the S&P bounce 30, 40, 50 handles in a straight line, and then roll over and do 100 handles in a straight line to the downside. Okay, keep an open mind. That is the key to trading these sorts of volatile conditions. Okay, any questions? Do post in the Discord. Otherwise, good luck out there. Manage the risk. Go make some money.